Good morning. Yes, thank you. Yeah, that is a bold call, and that was definitely the very strong view that I had about 4 weeks ago. I will very readily admit that I'm a little bit more nervous about today's measure that we're going to see later today. I think, as you said at the top of the hour, if you were to see something with a 7 handle, that'll be taken very positively. Unfortunately, I don't think that is what we will see. You've mentioned a lot of the prices that we've seen rising over the last month or so, and they've been worrying. The other one that I would throw in there is the used car prices as well. Now, that was the big contributor to rising prices over much of the last few months or so. That's been fading, and we were expecting that to continue to fade. Unfortunately, if you look at the Mannheim used car prices, they rose over the last month or so. So that certainly suggests that the decline is going to be much slower, and there is certainly a risk that we do get an upwards surprise here. So I'm looking for inflation to sort of come in more or less in line with the surveys, around about the 8.3 mark today. I would not be surprised to see it a little bit higher than that. If it is higher than 8.5, that peak that we saw in March, and if I'm wrong, then I think there's going to be some serious question marks, and I don't think the market's going to take that particularly well today. But longer term, going forward, I think still we are seeing this rotation from goods inflation to services inflation, and I think there are some signs that inventory levels are starting to creep up a little bit. They're still low, but I think that can start to put some gradual downward pressure on inflation. And at the same time, we've got to remember that base effects are really going to start to creep into inflation. But I think the final thing to say is it is a bold call, and I think the thing that where I've changed my view in the last month or so is that I think the glide path, the path down in inflation, is probably going to be slower than I previously had expected.
Benjamin, I was going to ask you a question which is, I guess it's a bit technical, which is different types of inflation, whether it's more on the demand side than the supply side, but I think that's boring compared to what I really want to ask you. Given what you just said, if we get a print that you are very nervous about today, by your own words, that does get to 8.5 and the cause remains stagnant or goes up from the previous figure we saw, does this market have the ability to crash given the lack of liquidity that everyone's been talking about? Would it potentially have the ability to crash this afternoon?
It depends on what you call a crash, really. I think equities would certainly be lower, yields would certainly be higher in that environment, and I think you can have a fairly significant move in that direction. I think there is still this kind of hope that inflation certainly will come down, and I'm not going to say that investors are positioned for that all in one direction. I think there's quite a lot of more mixed positioning today than there was at the beginning of this year. There's certainly a lot of optimism has been taken out of the market. I would say there's probably still quite a degree of pessimism, and I think that limits some of the downside. But I think if you did get that higher print, then the peak hawkishness argument that people have been talking about over the last sort of 6 weeks or so, I think that starts to go away, and you do have a fairly significant move lower on that piece of news.